Okay, so good morning. So last week, remember that we started with IFRS 16 on leases. And the point for leases was that entities might want to acquire assets and they might not want to outlay that huge amount to buy the asset. So they usually seek opportunity for them to get the asset, still get the asset, and pay instrumentally, right? So it's either they don't have the money or they just want to manage their cash flow. Either way, what is important for us here is that you are buying an asset and you are paying either monthly or you're paying annually. That is what the context of leases is about. So last week we identified that a lease has to be a contract, and the first thing we need to be able to do is we need to be able to identify a lease in a contract. And for you to identify a lease in a contract, we mentioned right of control. And we said right of control means that the lessee, who is the guy renting the asset, must have right to obtain substantially all the economic benefit attributable to the assets, meaning he must be the only one using the assets. That's the meaning of that. And two is that he must have right to direct the use of the asset, which means that he must be able to use the asset the way he wants it. That does not mean that the contract cannot specify the usage, but it should not be restrictive. You cannot rent a car and the contract is saying that you can only plow the car between Aja and Lekki. That's restrictive. If that's the terms of the contract, then the lessee does not have right to direct the use. Okay? If you are renting a car, you should be able to use it anywhere, anytime, right? That's right to direct the use. And also in identifying a lease in a contract, we mentioned that we should be able to, there should be an identified asset, meaning the contract must specify the asset. If the contract is such that the lessor says you can pick any asset whenever you need it, then that's not a lease contract, because the contract or because the assets must be what? Specified. And also, the lessor must not be able to substitute the asset except for repairs and maintenance. So we cannot start a lease arrangement and the lessor comes and say, give me the asset and brings another one. No, that cannot happen. If that happens, then it is not a lease. For it to be a lease, it cannot substitute it. Once we start with an asset, we have to end with it. So the only instance where substitution can happen is when there is need for repairs and maintenance, that the lessor has to repair it, he comes to take it, gives us another one. After the repairs, he has to return it. So majorly, that's how to identify a lease in a contract. Then we also mention about the lease term, which is the period over which the lessee has right of use or right of control. And we said that period can be extended. And we're going to consider that period of extension if it is favorable for the lessee to extend. That one is very important. If it is favorable for the lessee to extend, that is when you consider that extension as part of the lease term. Then we went on to the accounting for lease itself. We said we'll look at both for lessee and lessor. Last week, I laid down the principle for lessee. Today, quickly now, I will lay down the principle for lessor. Then we'll solve questions on everything. Then we'll round up hopefully today on leases. Now, for lessee, I told you that IFRS 16 has cancelled out the issues of operating or finance lease. As far as lessee is concerned, they have cancelled it out. Because what they discovered that because of that opportunity for distinction, people were using it for window dressing or creative accounting. So, because the way it works then was that for finance lease, they will say that if the lessee is going to be like the ultimate owner of the asset eventually, then that one is a finance lease. But if the lessee will not be the ultimate owner, that one is an operating lease. So they left it for the discretion of the lessee to decide which one. So most often than not, they are tending towards operating lease. Because for operating, you don't have to put liability in your books. You don't have to put anything in your books. All you just need to put in your books is just rent expense every year. So Those that want to make their book look beautiful, that does not want people to know that they have borrowed an asset, right? They will just say it's operating, even though in substance it's finance. So people were using it for off-balance sheet financing. That was a major downfall of the old IS 17. So they brought in IFRS 16. And that's the principle I taught you last week, that whatever the lease arrangement, in as much as you are a lessee, you need the asset. In fact, you will have bought it. It's because you have an opportunity to lease. That was why we went for it. So every time we enter into a lease arrangement, there must always be a lease liability and a right of use asset in the books of the lessee. That has to be remembered. For lessee, he must recognize the liability, he must recognize the assets in his books that we called right of use asset. And we mentioned that even though the lessee is not the owner, but the standard is saying he can put the asset in his books and as his own. I told you that that's in compliance with the concept of substance over form. We mentioned that also last week. So when he has a lease liability, at how much will he put it in his books? It's just like he's paying a rent of 10,000 every year for 5 years. That means he has a liability of 50,000. Just that we cannot recognize future value in our books. What we recognize in our books is present value. So we need to discount it to present value. And in discounting it, since this is an annual payment, we cannot use just any discounting but annuity factor to discount it back to present value. So for the lease liability, we said that is initially recognized at commencement date at the present value of unpaid lease rental. The present value of unpaid what? Lease rental. So all the lease rental he has not paid, discount it to present value. That's the lease liability. And the other leg goes to right of use asset. That completes the double entry for that. Credit the liability, debit the right of use asset. And for the liability at the end of the year, you will increase it with interest, you decrease it with the lease rental because you will start paying the rent. However, you need to watch out. If the lease rental is paid at the beginning of every year, you deduct it first with the lease rental before you add the interest. We'll solve questions on that today. And that was all about lease liability. And for the right of use assets, in addition to the PV of unpaid lease rental that went to the right of use asset, in order to have a complete picture of the right of use asset, if there is any amount paid at the commencement date, that will also be added. If there is any initial direct cost, that will also be added. If there is any decommissioning cost, decommissioning is the short word for removal, dismantling, and restoring the site back to its initial condition. That's what we call decommissioning cost. All that will be added as part of the cost of the right of use asset. And at the end of the year, you simply depreciate the right of use asset over the lower of the lease term or the economic life of the asset. They will give you the two. You just need to pick the lower. Depreciate the right of use assets over that period. So majorly, that was what we discussed last week. So today, we'll solve questions on that to see how it actually works practically. Now, before we get there, okay, you have a question? Take it.
You initially said the present value of the unpaid lease rental will be credited to the liability and then debit the right of use asset. So what will happen to the initial down payment made? How is the accounting entry going to be?
So the initial down payment made, so that you just simply credit bank because you have paid and you debit the right of use asset. Yeah, that's it. Yes. You debit the right of use asset. So if you check what I gave you, the right of use asset, first, what goes there is the PV of the unpaid lease rental. Then you will add the amount paid at the commencement date. That's the initial deposit you're talking about. Very good question. Any other one? At the initial date? No, nothing. Nothing goes to P&L except at the end of the year. You will see all of that today. Okay, now before we start solving questions, let's quickly look at the principles for the lessor, right? Then we start solving question on everything. Okay, so today we are starting with lessor accounting. Lessor accounting. Okay, now you know that the lessor is the original owner of the assets. He is the original owner. So there is no shenanigan he wants to pull. He is the owner. So now IFRS 16 allows him to do that classification into operating and finance lease. So for the lessor, the first thing the lessor does is to classify the lease into either a finance lease or it classifies it as an operating lease. So at what point will it classify as a finance lease? It is a finance lease where the lessor has transferred the substantial risk and reward. Then it is a finance lease where the lessor has transferred the substantial risk and reward, of course, attributable to the assets, around the assets. So now, and when we say you have transferred substantial risk and reward, that's as good as saying you have sold the assets. It's as good as saying that, right? But what are the indicators that shows that the lessor has transferred substantial risk and reward? You need to know five. You need to know five. Because they could ask you in the exam. Indicators of finance lease. So these 5 points you have to know it. Now the first one is this. There will be transfer of ownership. There will be transfer of ownership to the lessee at the end of the lease term. This is one of the indicators where there will be transfer of ownership. The second indicator is that there is a purchase option. And you know what a purchase option is? Which is an opportunity for the lessee to buy the asset at the end of the lease term. So there will be a purchase option that is small or very small. That is very small when compared with the fair value of the asset at the end of the listing. The main point here is that there is a purchase option. Whenever there is, but it has to be small when compared to the fair value of the assets at the end of the lease. And what we are saying here is this: if at the end of the lease term, the lessor says that you can buy this asset for 1,000 though. But if he was to buy it at the open market, he will have bought it for like 7,000 or thereabouts. So where the purchase option is small relative to the fair value in the open market, then you know that that's an indicator of a finance lease. The third one is that the lease term, the lease term is a substantial part. The lease term is a substantial part of the economic life of the asset. The lease term is a substantial part of the economic life of the asset. So when the lease time is almost equal to the economic life of the asset, so it's as good as the guy has sold it. So the next point is that the present value of lease rental, the present value of lease rental is almost equal to the fair value of the assets. The present value of lease rental is almost equal. That means the money the lessor is going to receive is equal to the selling price of the assets. So that's a finance lease. And finally, point five, the assets is a specialized asset. The asset is a specialized asset that only the lessee can use it without substantial modification. The asset is a specialized asset that only the lessee can use it without substantial modification. So again, these are areas where you can easily pick points in the exam. They can ask you this theoretically to list the indicators of a finance lease, or what are the indicators that shows that a lessor has transferred substantial risk and reward. So these are those indicators. Sorry? That the asset is a specialized asset. Okay, so you know what a specialized asset is? An asset that is tailor-made for a manufacturer. Maybe you have a factory where you manufacture certain goods, let's say palm slippers, and you have your own design. So they have crafted that asset in such a way that it suits your manufacturing purposes. And no other person can use it except you. So if you have that kind of asset and you leased it, then it's likely going to be a what? A finance. So you need to know this five. You have to know it. Now, you see, in identifying whether it is a finance lease or an operating lease, what you look out for is just finance lease. So if you don't see all of this, because it needs to meet all of this, all of it. The only thing is this: if it's a specialized asset, so you don't even need to look out for all of it because automatically it will meet it, right? But if it is not a specialized asset, it has to meet everything. Everything. If it doesn't meet one, then it is not a finance lease. So, and that's immediately it is not a finance lease, then automatically is what? Automatically. And for operating lease, it's just the opposite. That the lessor has not transferred the substantial risk and reward attributable to the assets. And that's operating lease. Now let's pick them one by one. Let's start with accounting for finance lease. When we are done with that, we move to accounting for operating lease. So, accounting for finance lease. Okay, now from the meaning of finance lease, which I told you is basically similar to that the lessor has sold the asset. It's as good as that. Just that instead of collecting money outrightly, it's collecting money in bits, right? So you know that when you have that kind of cash flow trends, right, whereby you have an investment and you are collecting money periodically without doing anything. I've already mentioned it. That's as good as an investment for you. And your reporting, that is what we call financial assets, which we are still going to look at very soon. So this guy, the lessor, in his book, he might be having that asset before as PPE or maybe intangible assets, depending on what type of assets we are talking about. As soon as he enters into a finance lease arrangement, it stops being PPE because the way PPE generates money is different from the way leases generate money. For leases, you don't have to do anything. Just go and sleep. They will be crediting your account. So he reclassifies it immediately and it stops being PPE. Immediately he recognizes the assets. He recognizes what we call a net investment, in the lease, or they call it lease receivable. This is what he's going to have in his books. He won't recognize the asset anymore. What he recognizes is that the fact that it is now an investment. We call it net investment in what? In the lease, or you can call it lease receivable. And the way it's computed is quite straightforward too. It's similar to the way the lessee looks at it because lease receivable or net investment in the lease, all it will account for as that investment is all the money is expecting. And for lease arrangement, he knows it. He knows how much he's going to collect annually. All he just needs to do is just to discount it to present value. So what he recognizes is the present value of lease rentals receivable. Present value of lease rental receivable, which is similar to what the lessee will have done as a liability. Him is putting it as what? As an investment. However, for the lessor, there is something that usually happens because being the owner of the asset, you usually want to ensure that the lessee uses the asset rightly. So, in such a way that they always agree a kind of residual value, a kind of a small value that at the end of the lease term, the lessor will say, I should be able to get something from this asset. You should not finish it. There should be something I can get. So the lessor will commit the lessee that you must guarantee me that at the end of the lease term, I will get something. IFRS 16 calls that guaranteed residual value. He calls it what? Guaranteed residual value. You know what a residual value is? The value of the asset at the end of it. For this one, he said the lessee will guarantee that don't worry, even if I destroy this asset before the end, I will give you the cash equivalent. So I'm guaranteeing you that you will get certain amount at the end of the what? The list, and that this asset will be worth certain amount. So the lessor, what they usually agree is that, okay, how much do you want to guarantee me? Whatever the amount is, they will have factored in it into this one. So if the rent the lessee is supposed to be paying is supposed to be, let's say, 10,000, by the time they calculate the residual value guaranteed, maybe it can be 11,000 per annum. But the point is that it would be included where? Here. You have to consider it here as part of what is going to pay annually. Okay. However, they don't usually agree. Some of them will not agree. If the lessor says that from the way I'm looking at this asset, I should be able to get 100,000 at the end of it lease time. The lessee will say, Oga, you can't get 100,000. Me, I can't guarantee you 100,000. What I can guarantee you is 70K. They will shall go back and forth. Eventually, they will agree to maybe 80. But in most cases, theoretically though, the examiner, sorry, the lessor will insist that he should be able to get 100,000. Should be able to get. The lessor will say, okay, I can only guarantee you 80K max. Fine. So that 80K, they will work it here. But for the fact that the lessor believes he can get 100,000, that means there is a 20,000 that has not been what? Guaranteed. He will add it as part of what he is expecting, even though the lessee is not going to pay it. But he will add it as part of what is what? Expecting. So in addition to this PV of lease rental receivable, he will also add the unguaranteed residual value. But for the fact that it's a future amount, because it's an amount that will be realized at the end of the lease term, it needs to also discount it to what? Present value. So in addition to this, we need to get the PV of what? My phone. It's my phone. Okay. And all this is done at the commencement date. This is done at the commencement date. The PV of the lease rental receivable and also the PV of unguaranteed residual value. This is what the lessor is expecting. Okay, so the guaranteed is already inside the lease rental. Yes, they will have factored it in. That one is inside already. So the one that is not inside, that the lessor believes he will still get additionally, that's the one we are adding again. So the two are inside. It will not be there because he's not paying it. The guy has told him that he cannot guarantee that. So he's the one that is putting in. So no problem. There are two distinct people. Okay. Now, at the end of the year, what happens? Just the same thing the lessee has done in his books. This guy will also do it. So at the end of the year, at the end of the year, if the lease rental is received at the end, then you increase the net investment with what? With finance income or interest, and you decrease the net investment with lease rentals. Just similar to what the lessee will have done. But if the lease rental is received at the beginning, what the guy simply does is that it decreases first. It decreases the net investment with what? With lease rental, and it will increase it increase the net investment with finance income. So that's everything for finance lease. That's it for finance lease. Any questions before we move to operating lease? This one no strike. Bro. Okay.
What's the difference between the beginning and then because it's still increase with the finance cost and increase with finance cost, here it also decrease with lease rental and just that the number change from number one to number two to number one.
In that second one, right, the interest, it will be calculated on the net. By the time you have deducted the lease rental, that is when you calculate the lease rental on it. But this one, the interest is calculated on the opening. The interest will not be the same in both scenarios. This one, the interest is calculated on opening figure. If it is, let's say 10 naira. But in this second one, you deduct if the lease rental is 2 naira, you deduct 2 naira first. So 8 naira is what you calculate the interest on. It will be the same. They are very different. Okay. Now, for operating lease, for operating lease, because this one doesn't involve transfer of substantial risk and reward. All the lessor does is just to recognize the lease rental to POL every year. But what the standard said is this. He said the lessor should recognize the lease rental on a straight line basis per annum. This is the thing about this for operating lease. All the lessor must ensure it does is that the lease rental is getting must be recognized equally. That's what we mean by straight line basis. Equally every year. So if it's recognizing 20,000 in year one, it must recognize 20,000 all through the life or all through the lease time. So that's for this one, operating lease. There is a final one that ordinarily is beyond the scope here. I just want to introduce it because it's straightforward. There's really nothing to it. And that's a scenario whereby the lessor is also a manufacturer or a dealer in that item. The easiest example I can give is that if the lessor sells car, that's what he does. He sells car. He now lease one of them, or somebody came to him that he wants to lease a car. He now enter into a lease arrangement with that person. So that kind of lessor we call him a manufacturer or a dealer lessor. Okay, so that's not what he does. It's not leasing that is his main core. His main core is that he actually sells that item. So he just enter into a lease arrangement. If that is the case, yes, he has leased the assets quite all right. He's going to recognize the assets as net investment in the lease, just as I've demonstrated here. But for the fact that he's a manufacturer or a dealer lessor, the standard said he must also recognize a gross profit. He must also recognize a what? A gross profit in his books, right? So they are still trying to treat it as if he has actually sold it. But how will he calculate gross profit? Sales minus cost of sales, abi? So let's see how he get the sales and how we get the cost of sales. So manufacturer or dealer lessor. So in addition to recognizing a net investment in the lease, the lessor must also recognize a what? A gross profit. And the gross profit, as you know it, is simply sales minus what? Cost of sales. Gross profit is simply sales minus cost of sales. Now, the way you get is sales. If you sell an asset, the price you receive to sell an asset, we call it fair value or the selling price of that asset. That's fair value. But in this lease arrangement, because it's entering into a lease arrangement, what you will actually receive on this asset is the what? The lease receivable or the net investment in the lease. That's what he will actually receive. Therefore, the standard said that what he recognizes as sales is actually the lower between the two. Between the fair value of the assets, so they will give us the fair value, which is the selling price, and the lease receivable. But the challenge with this lease receivable is this one. This PV of unguaranteed residual value, which for us, it looks like a wishful thinking on the part of the lessor, believing he can get additional to what the lessee has guaranteed him. So we cannot recognize something like that as sales. That cannot be sales. So we are going to restrict that, what can go in as sales, to what? To this one. We restrict it to this one. So lower of fair value and PV of lease rentals receivable. So whatever the lower is the lower. And why are we going for lower? Because we are prudent. If you remember, under fundamental characteristics, under faithful representation, prudence is extremely important for us. We have to be very slow in the recognition of income. So most of the time, as we move on, you will see that whenever we want to recognize asset and income, we always pick the lower of something if we have that choice. It's always the lower we have to go for. So the lower between fair value and present value of lease rentals. What about the cost of sales? How about the cost of sales? The cost of sales, of course, that will be the cost of the assets. Abi? That will be the cost of the asset, or they can give you the carrying amount, whatever they call it, but majorly the cost of the asset. However, the thing is this: the gross profit we are looking at the fact that this guy can make money from this asset, and what is the gross profit he will make from this asset. And remember, these sales, we have refused to consider the PV of unguaranteed residual value because we cannot consider it as sales. But he might still get it and he might not get it. So, because it's two ways, we say don't put it as sales. But we still have to factor it in one way or the other. So, the way they say we should factor it in is that when they give us the cost or carrying amount in this cost of sales, the cost or carrying amount of the asset, you simply come here and deduct the PV of what? Whatever you get here, this gives us our gross profit. And this is what I'm saying here. For this, the reason why I've deducted the PV of unguaranteed reserve value, this is what I'm saying. So if let's say the sales is 10, but if we have added the PV of unguaranteed residual value, which is 2, it will have become 12. But we said don't add it because we are not sure whether the lessor will get it or not. That don't put that as sales. So we put it as 10. And the cost of the assets ordinarily is 5. It's 5. You know that ordinarily, if we had considered these 2 here, what would be our gross profit? 7. We still need to get this 7. The only way we can do it is to remove it from what? From here. From the cost. If you are not going to increase your income with an amount simply because accounting says you cannot go, just go and use it to reduce your what? Your cost. This one becomes how much? Then we still get the same thing. And that is why IFRS 16 is saying, okay, in determining gross profit, don't consider unguaranteed residual value as part of your sales here. Only consider the PV of lease rental. But come and remove it from here. So that it's still going to have the same effect on your what? On your gross profit. And that's the gist around that. I just gave you that as a bonus in case, right? Okay, and that is it for lessor accounting. And really, that is it for leases, IFRS 16. So now, what we are left with is now to solve questions. And you see, I sent you something. Oh, fantastic. She printed it already. So the reason I sent you this is because I know that if I have to solve this, we have like around 1.5 hours to go. And with the number of questions I have to solve, if you I have to be waiting for you to write, I will not finish. That's why I intentionally sent you part of my own textbook. That okay, the solutions are there, so that I won't be waiting for you to be writing the solutions. I won't be waiting for you. So you have an option. If you take priority in writing the solution than listening, it's okay. Right? If you can listen and write at the same time, you can quickly write it. But as soon as I'm finishing a question, what I expect from you is to ask me questions. If there are no questions, I move to the next one. So you also have, if you want to insist that you want to write what I wrote on the board, which is the same thing as what is here, you can snap it and go and write in your note later. But I will not wait for you to write. We will not finish up. And I have to finish this today. So, brother, let's start. So, where's your own book? Open your book now. This is my own today. Okay. It's in the pack. Oh. You can actually use the pack. Yeah. And this one is just has solutions and some extra notes. I have to check. Verse 16, page 66. Okay, let's go to page 67, question 2.1. We have not solved any question on leases, Abi? Okay. So page 67, question 2.1.
Okay, sir. So here we are going to determine whether the above contract is a lease contract. The question: BDO Transport Company entered into a 3-year contract with CML, under which CML supplies BDO with 5 luxurious buses for the purpose of interstate transport. CML owns the entire 5 buses specified in the contract. BDO determines the route taken for the interstate transport as well as the pricing. BDO can choose to use the buses for purposes other than the interstate transport. When the buses are not being used, they are kept at the premises of BDO and cannot be retrieved by CML unless BDO defaults on payment. If the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the same type of buses. We are to determine whether the above contract is a lease contract or not.
Okay. So we need to determine whether this contract is a lease contract. Okay. So if they ask you something like this in the exam, the first thing we identify or you state in the exam is to state the principles. The principles, you have to state it. Don't just go ahead and start. State the principle. And the principle here in identifying a lease in a contract is just right of control. Right? And right of control is two things: right to obtain substantially all economic benefits and right to direct the use of the asset. In addition to that, we have there must be an identified asset, which means that the asset must be specified in a contract, and also the lessor must not be able to substitute the assets. That's the core principle. So now let's look at this case. Can you tell me anything that shows that BDO or that this contract is a lease? Is there anything we can spot here? Nothing. What are they? Okay, so there is an identified asset, Abi, because the contract specifically mentioned 5 luxurious buses. Okay, that's correct. Which other one?
There's right of control. BDO determines the route taken for interstate transport.
Is that first paragraph? Okay, yeah, that's correct. BDO determines the route taken for the, so that is not even right of control. That's right to direct the use, right? So what I need you to mention is what shows it, because you'll have mentioned the principle up. Then you now start mentioning those points directly from the case. So from here now, we can see BDO direct determines the route, which is also correct. Which other one?
BDO can choose to use the buses for purpose.
That's also an indicator that BDO can choose to use the buses for purposes other than the interstate transport. So still on right to direct the use. Okay, which other one?
When the buses are not being used, they are kept at the premises of BDO and cannot be replaced.
That's also an indicator which shows that the guy cannot substitute it, or the guy cannot even use it at all. There is only BDO that is using it. So he obtains substantially all the economic benefits. So it's kept in the premises of BDO and cannot be retrieved by CMA except there is default, which is okay. Okay, I mean that's all.
The bus cannot be substituted except where it needs to be serviced. I think where it needs to be serviced.
Yeah. That last paragraph also mentioned it also, right? That is only when there is need for servicing that CML can come and substitute it. Okay, all these points I've already noted it in the answer here. If you look at those notes, you can see it there. Yeah. Question 2.2.
Okay, sir. We are to determine whether the above contract is a lease contract also. So, BDO Transport Limited has recently made substantial cuts to its interstate transport service. It will now provide such services only in cases of great need. It has entered into a 2-year contract with CML for the use of one of its luxurious bus for the interstate transport. The luxurious bus must seat 45 people, but CML can use any of its 45-seater luxurious buses when required. The luxurious buses are held on CML premises and are only made available to BDO on request. Determine whether the above contract is a lease contract.
You can do the analysis as people are talking. So, is this a lease contract?
No.
Why?
There's no specified asset. It can be any of.
Give it to him. Did he hear you?
Okay. It's not from the above. It is not a lease contract. The reason being that number one, the no specific item is mentioned. It's just that mean that BDO is free to use any of the
Okay, that's
luxurious
correct.
buses,
Yeah, now there
but
is no identified asset.
it's not identified asset.
The
Have you?
rights to direct to.
Yes.
Which one
So
is it?
also there yes, there's no control because
You
BDO
said unknown assets
yes unknown as
remains with BDO.
okay.
Okay.
Yeah, and it's also and the boss is giving out when there's a when the request yes when they need it.
Okay, I think it's just those two. That's correct. I mean, what we have spotted here is that one, the there is no identified asset, Abi, and two, um, CML can use any of its 45 seater. They said that CML can use it, so that means not only BDO that is using it, and it is even in the premises of CML that BDO can use it only on request, right? So I think those points I've already mentioned it. Okay, let's go to 2.3. So this is not a list contract.
Okay, WASPA enters into a 10-year contract with telecom company, Tele, for the right to use three specified physically dark fibers within a larger fiber optic cable connecting Osun to Ibadan. WASPA makes the decision about the use of the fibers by connecting each end of the fibers to its electronic equipment. Powers the fibers and decides what data and how much data those fibers will transport. Required, determine whether the above contract is a lease contract.
Okay, give it to Mr. Mo. Is this a list contract? Not.
It's a lease contract now since
Is
what
there an identified asset?
the fiber.
Okay, yeah, yeah. About the use of the fiber.
Yes.
Yeah, that's correct. Yeah, you can't do it right. Let's go to 2.5. Now, for this 2.5, okay, for this 2.5, you will read it. So, would you like to talk? Would you like to talk? Okay, so you'll be the first to analyze it and tell me whether it's a lease contract or not. If you don't get it right, Yunusa, you would you are going to take it up. If you don't get if it doesn't get it right, if Yunusa does not get it right, you would also support. So I believe one of the three of you should be able to do it. Okay, let's start. Let's read it. Let's pay close attention to this.
Okay. Under a 4-year Sam. Yeah. Under a 4-year agreement, a car seat wholesaler, car seat, buys its seats from a manufacturer, Manufac. Under the term of the agreement, car seat licenses its know-how to Manufac royalty, free to allow it to construct a machine capable of manufacturing the car seat to car seat specifications. Ownership of the know-how remains with car seat, and the machine has an economic life of 4 years. Car seat pays an amount per car seat produced by Manufac. However, the agreement states that a minimum payment will be guaranteed each year to allow Manufac to recover the cost of its investment in the machinery. The agreement states that the machinery cannot be used to make seats for other customers of Manufac, and that car seats can purchase the machinery at any time at a price equivalent to the minimum guaranteed payment not yet paid. How should car seats account for these arrangements? I will take the question to, is there a lease contract here or not? Let's not go for the accounting. What's your name? Barry. Timmy. Okay. Then. Are you ready? Okay. Let's give him the.
There's a lease contract, or it's a finance lease.
Finance lease. Okay, so what did you see there? What informed your decision?
Car seat has the right to purchase the assets at a later date or at an agreed amount. Yes, at an agreed amount at a price equivalent to the minimum guaranteed payment not yet made.
So let me help you. Who is the lessee and who is the lessee?
The lessee, who is the person who is entering it, is car seat, and I think manufac is the lessor.
Okay, is there an identified asset?
Yes, car seats or seats. No, there's none. There's none. It's just general
If there is no identified asset, why did you say there is a lease contract? If there's no identified asset, it can't be a lease contract.
contract.
That's right.
Yunusa, it's your turn. He has done his best. Is this a lease contract or not?
It's a lease contract
It is a lease contract. So what did you see?
because car seat manufactures a car seat specifically for car seat alone, and with that it's a lease contract.
Okay, so the question is this: who is the lessee here and who is the lessor?
Car seat is the lessee, manufact is the lessor.
Okay, good. Is there an identified asset here? Those are the things you look at. Is there an identified asset? I mean, if you say there's a lease, which asset did he lease?
I think the license to
Not the
produce.
license. Not the license. Who can tell me? No, no, who can tell me? I already called people. Sam. So they have answered it. Do you agree that this is a lease contract? I won't say no, sir. So you agree that it's a lease contract? No, sir. It is not a lease contract. Yes, sir. Okay. Don't say more. Do not say more. Gloria, is this a lease contract? Hold it. Is this a lease contract?
I would say is a specialized asset. Is a lease contract, a finance lease contract.
Finance lease. Okay. Okay. So yeah, finance or no finance is not what is important to us here. Here is to identify a lease. You just need to point out right of control and an identified asset. That's all we need.
There is
So
an
what is the identified asset here?
the car seat
No, it's not. It's not the car
license.
seat. Similarly, okay. That's correct. Yeah, it's the machinery. That's correct. It's the machinery. Okay, good. So you have figured out the identified asset. So figure out the right of control. How does car seat has right of control here? That's correct. What's your name? Patience. Okay. So Patience said that it cannot be used to make car seat for any other customer except for whom? Except for car seats. And that is it. Those are only the indicators there. Okay, see, why I intentionally spread this one is because it's not so straightforward, and I know that. And that's because this particular contract has multiple components. It has what? Multiple components. If you look at that question again, if you go and read it again, you will see that there are two components here. One is that a normal purchase contract, which is that the fact that car seat is buying seats from manufacturer. That one has nothing to do with the lease. It has nothing. That one is just a normal purchase. I
I buy seat from you, I give you money, you give me my seat. That's that one. Where the lease came in is where car seat started saying that I want you to manufacture my seat in a certain way. He now gave him a technical know-how. And that one is even free. So the technical know-how is not even the issue because he gave him for free. So that technical know-how, the main reason is that so that manufacturer can manufacture a machine, right? That will now manufacture the seat the way he wants it, the way car seat wants the seat. So now, then there's now an asset, machinery. So that machinery now, there's an asset. Now, where does the right of control comes? See, where the right of control comes is the fact that manufacturer cannot use the machine for any other person. He is a lease. He cannot use it for any other person except for car seats. So that means car seat has right of because he's the one that is obtaining all the economic benefit attributable to that asset and is even directing the use. What he can use to produce it and whatever. He has the technical know-how. He helped him to, and there are more to multiple component contracts. There are more to it, which is, but for me, what I need you to know is that something like that exists. A contract can have more than one component. It doesn't necessarily have to be just lease contract. It can be a normal purchase contract and a lease contract. You just need to look at it. Is there an identified asset? Is there a right of control? That is all we need to look at to know whether there is a lease or not. So the way we account for it is quite different because there will be only one payment. Here now, car seat is only paying for the car seat. It's only paying for the seat. The standard said that you have to separate whatever is paying into the normal purchase, what is paying for the seat, and the lease renter. That we will not discuss here. Yeah, that I will not ask you. Okay, so you need to separate it. You have to separate the purchase consideration or whatever is paying, the car seat is paying for the seat, separate it into the purchase price of the car seat and also the what? Lease renter. The standard said the separation should be done based on their standalone selling prices. Based on their what? Standalone prices. Because you will find out that what car seat will now be paying for these seats will be more than what he will have paid if he has gone to buy it outside. Because if he has gone to buy it outside, he might probably be paying 10 naira. But for the fact that manufacturer agrees to use the machine for him alone, he will add a premium of let's say 2 naira. That premium is the lease rental. That 10 naira you can buy it outside is the normal purchase price. Okay? But what you need to know is for me to be sure that you understand the fact that a contract can have multiple components. And the way to identify the lease portion is one, is there an identified asset? Two, is there a right of control? That is it. And which you have identified here. Sam. Page question 3.1. Is that correct?
Yes, sir.
Yeah. Let's read 3.1.
Okay. A lease contract is for 5 years with lease payments of 10,000 naira per annum. The lease contract contains a clause which allows the lessee to extend the lease for a further period of 3 years for a lease payment of 5 naira per annum, as it is unlikely the lessor would be able to lease the asset to another party. The economic life of the asset is estimated to be approximately 8 years. What is the lease term?
Okay. What's the lease time here now? Why? Okay, is that the only thing? It's favorable. It's favorable. That's even more important. That's what you have to look out for, not just the extension. Yes, there's an extension, but the question should be, is it favorable? But how did you know it's favorable? It's paying 5 naira. Something that he was paying 10,000 naira before. They now said he should now pay 5 naira. That's favorable. What can be more favorable than that? Extremely favorable. Let's go to the next question. That should be 4.3.
4.3.
Yeah, 4.3.
Okay. Here, we're required to show the financial statement extract of Net Worth Limited over the relevant period.
If they ask you a question like this, show a financial statement extract. That means you're supposed to prepare a financial statement. Yeah, you're supposed to prepare a financial statement. So, whatever you are doing before that preparation will be your workings. Let's read the question.
Okay. On 1st January 2002, Network Limited bought a plant from Password Limited under lease contract. The terms of the lease requires Network to make 4 annual installments of 2 million naira, each payable at 31st December. The present value of the lease payment is 5.7 million naira. The interest rate implicit in the lease is 15% per annum, and it is estimated that the plant will become economically productive for 5 years. There is an opportunity to extend the lease term at conditions favorable to net worth. The reporting date of net worth is 31st December. Show the financial statement extract of Net Worth Limited over the relevance period.
Okay, now net worth. Is net worth a lessee or a lessor? So at 1st January 2002, Abi, you will need to recognize both a lease liability and a right of use assets. So let's start with the lease liability. And he recognizes the lease liability at the PV of what? Of unpaid lease rentals. And in this question, how do we get the PV of unpaid lease rental at the commencement date? Sorry? Is in the question? How much? Okay, so I think this is a very good question. A financial reporting question shouldn't be around testing you how to calculate the PV of lease rental. It shouldn't be around that. But in case, the other way they can tell you is that they will give you the annual payment, right? And they might give you the annuity factor. What you need to do is just to multiply the two together. That will give you this. To give you the 5.7 million. Or they might not give you the annuity factor. They might require you to calculate the annuity factor yourself. That 1 minus 1 plus r raised to power minus n divided by r. Right? But most questions these days don't require you to do all of that because that's not reporting. Nobody should be testing that. But in case, know it and be able to calculate your annuity factor, just multiply by the annual amount, then that give you your PV of unpaid lease rentals. And that's at the commencement date. The other leg of this will go to where? Right of use assets. That's where the other leg will go. But let's finish up with the lease liability. So at the end of the year, at the end of 2002, at the beginning, we are bringing forth 5.7 million. Then we need to check when is the lease rental paid. Is it paid at the beginning of every year or at the end of every year? At the end of every year. So that means we are going to add the finance cost first before we deduct the lease rental. So the finance costs at which rate now? 15%. So what's 15% of 5.7 million? 855. Then we would have lease rental. How much are we paying per annum? 2 million. So what's our balance at the end? What's our balance at the end? 4,000. Okay, so this year one. By the time I prepare my statement now, you will see that finance costs will go to P or L. We go to where? P or L. This one, this 4555 is our liability at the end of the year. But my question to you is this. This 4555, is it a current liability or a non-current liability? Current or non-current? You. What's your name? Ada. Ada is a current or non-current? This 4555, our lease liability at the end of year one, is it a current liability or non-current liability, Ada? It's current liability. What's your name? Odu. Current or non-current? Non-current. Gloria, current or non-current?
Correct, because it's going to be 1 year, not exceed 1 year.
Says who? Says Gloria. What's your name? I saw that I just walked in now. Current or non-current? Non-current. I saw that I just walked in now. Okay. What's your name? Asuko, yeah. Current or non-current?
Non-current.
Non-current. Sorry? Similar, you say current. What's your own name? Stephanie, current or non-current? It's current. What's your own name? Sorry? Yeah. Current or non-current? Non-current. Sam. Non-current. Mr. Omar. Non-current. What's your name? Faith. Current or non-current?
I think it's correct.
Current. Non-current. Unisa.
Non-current.
Non-current. What's your own name? Ayodeji. Non-current. What's your own name? Peter. Current or non-current? Is a current liability. The guy beside Peter. What's your own name? Temiloluwa. Current or non-current? Non-current. What's your own name? Sorry? Odufa. What's current or non-current? Non-current. It's such a mixture. What's your own name? Sorry?
Clement.
Clement. Current or non-current? Non-current. What's your own name? Sorry? Mary. Current or non-current? No, it can't be all of the above. It can't be all of the above. You have to choose one. Current. Non-current. What's your own name? Sorry? Mali. Malik. Abdul Malik. Current or non-current? Current. Latecomer. What's your own name? Savings. Savings. Wow. Current or non-current? Non-current. Forgot your name.
I'm glad. I'm very happy. Don't correct.
Remind me.
No, sir.
No, I remember. Current. What's your name? Sorry? Slim, yes. John, current or non-current? Non-current. Victor, what's your own name? Chairman, Marcus, current or non-current? Non-current. What's your name? Festus, current or non-current? Non-current. Similar, you say current. A patience, current or non-current? Non-current. What's your own name? Adamson. Nelson, okay. Current or non-current? Non-current. The last guy that came to this class. What's your own name? Gideon. Current or non-current? Sorry? You just walked in. You have to choose. Which one are you going for? Non-current. So at least everybody mentioned something. Everybody mentioned something. What do you say? Yeah, tribunal will settle this. Okay, so it's actually the two. Yeah, it is both current and non-current, right? But for your exam, for you now, those that said current are wrong, right? Those, even though it's the two, but if you had said current, we would say it's wrong automatically. But if you say non-current, we can still give you. We can still give you, even though technically it's also wrong, but we can still allow you. So why is it the two? Look at it. What's the lease time here? 4 years. So lease liability means that at the end of the year, he's owing how much? He has this amount to pay for the next how many years? For the next 3 years. Is that current or non-current? That's non-current. That can't be current. A current is what you have to pay next year. If you have a liability that you have to settle next year or within 1 year, that is current. If you have a liability that settlement is more than 1 year, that is non-current. Why I said is the two is because in a lease arrangement, there are some portion that will be paid next year. There are some portion that will be paid what? Next year. So out of this amount, the portion that will be paid next year, that is current. The portion that will be paid after more than 1 year is non-current. For lease, the examiner always wants you to separate it when you are preparing your statement. You should be able to separate this amount into current and what? The best way to separate it is for you to do for the second year. Is for you to do what? Do for the second year. Whatever you have as the balance here means the one you are owing after more than 1 year. So out of this amount, whatever you get here is non-current. The difference between the two is current. That's the best way to do it. That's the shortcut way to do it. So let's test it out and see. So if I want to do 2003, so what's the balance brought forward here? 4555. What will be the finance cost here? 15% of 5555. 68. Why this one remain how much? So how much is here? Sorry? Eh? Lie. 1,000. This plus this minus this. 3,000. 2, 3. Because okay, so in year one now, if I want to separate this into current non-current, this one is the non-current. The difference between the two, most likely the one I will pay next year, that one will be current. That's the best way for you. If you want to separate this one will be the non-current. The difference between the two is the current. This one too, if I want to do for year two, I need to separate this into current and what? Non-current. I will have to do for the next year. Whatever balance I get here is the non-current portion because that is one I'm owing after. The difference between the two is the current. Let's see it. In 2004, I have 3238. What's 15% of 3238? 485.7. 486. So how much is this? 1724. So in year 2 now, this 3238, if I want to separate it now, this one, I'll just put it as non-current. The difference between the two, I'll put it as what? Current. The same thing I'll do here. So let's do the next one, 2005. 1724. How much is this? 15% of that. Sorry? 259. Ordinarily, this should be 0. Whatever you do there or you get might be an approximation error thereabout. I'll put mine as 0. Again, this one, for the fact that this is 0, that means this entirely will be paid next year. Abi? That means that this 1724 is entirely current because it's payable when? Next year. And that is all about the lease liability. Workings 1. Now, my workings 2 is the right of use assets. My right of use assets, I've told you, the corresponding leg for this one comes to where? Right of use asset. So the PV of unpaid lease rentals is 5.7. Was there any amount paid at the commencement date? Was there any initial direct cost? Was there any decommissioning cost? Okay, so that means my cost is simply 5.7 million. At the end of the year, I just simply do my annual what? My annual depreciation, which is this 5.7 million divided by the lower between the lease term and the economic life. So you depreciate over the lower of the lease term and the economic life. In this question, what's the lease term? 4 years. What's the economic life? 5 years. So, was there an option to extend? There was an option to extend. Is it favorable? It's favorable. Okay. So, we are extending to how many years now? We are extending by how many years? Habina, it cannot be more than the economic life of the assets. When the economic life is 5 years and the lease term is 4 years, and they tell us we can extend, automatically that means we are extending by 1 year the economic life. And that is why we are using 5 years here. Please, you need to note this one somewhere, that the only reason why I'm using 5 years here is because they told us in the question that we can extend. That we can what? And it's favorable. That is why I'm using 5 years. What if the question has told us that we can extend by 2 years and it's favorable? We can extend by 2 years and it's favorable. So that means in addition to 4 years, we have 2 years, 6 years. So what are we going to use? 5 years. Why? Is the lower. Okay? Is the lower. But in this case now, we simply use 5 years. So how much is this? Is this correct? I'm done with all my workings. So let's prepare our statements. Okay. So from these workings now, what goes to P or L? First thing is the finance cost, Abi. In year 1 is how much? In year 2, in year 3, in year 4. Then the next thing that goes to PRL is what? Year 1, year 2, year 3, year 4, year 5. Since we are using 5 years. And that's it. The costs. The accumulated depreciation. This is 1140 in year 1. The accumulated depreciation. In year 2 will be how much? 2280. Let me get here 3. 3420 in year 4. 4560 in year 5. So what's my carrying amount? Okay, so my non-current liabilities. I'll have lease liability here. And under my current liability, I'll also have lease liability here. So in the first year, I need to separate this 4555. This one is going to be the non-current portion, and that's 3238. 3238. The current portion will be the difference. So what's the difference between the two? 1317. In year 2, this 3328, this 1724 will be the current portion of it. The non-current portion, what's the difference? 1514. That will be the current. In year 3, this 1724 will be entirely current. So I'm going to put new here. And that is everything for this question. So this question is very good because it has shown you from the beginning to the end. Like if you understand this one, your exam really will not be more than this. Okay? It won't be more than this. You know what goes to POL, you know what goes to the statement of financial position. Which one? The lease renter. All we did for the lease renter is just to credit bank, debit the lease liability. So, which is already treated. Why the finance cost is going to P&L is that what we have done is that we have credited lease liability. The other leg is in P&L. That's why you are finding it in P&L.
I can't really get the gist here in this how to get the lower of something. This particular one, economic use. Can't get it. It's what you said about this economic extension, economic life.
Okay. So if you want to depreciate the right of use assets, we use the lower of the useful life and the lease term. That's it.
This woman.
That's it. So here now the lease term is 4 years, the useful life is 5 years. So ordinarily we should have depreciated the right of use asset over the lease term. We should have depreciated it over the
But
lease
you
term.
said something, you said if it is 7 years and the
Eh,
useful
I'm
life
coming
is
step by step. Do you understand what I've said so far? I want to help you step by step. Maybe after the class because you are not. I will explain it better for you.
for the asset. The estimated useful life is 4 years. So 5 years. So 5 years. After 5 years and the asset is 16 years, how do you get that?
That means you extend the useful life. That's practically. You just revise the useful life. I think we have mentioned something like that before in this class. Sam, next question, please. This is standard. These are the template given in IS1. This is recommended.
Like the assets falling under, right? Exactly. I've wanted to ask.
That's the template you given, and that's what I expect you to do in the exam.
So
They
doing
take it very
statement of
seriously.
financial position as a straight line is wrong.
Wrong. Right under it.
I get. Assets
The
is
reason is that under IS1 talks about identification of financial statements. Are you with me? First us, I'll give you punishment though. Under IS1, they talked about identification. And the way you identify is that they talked about the name of the reporting entity. So it must be separately presented. The title, which is the statement, separately. The reporting date must be separately presented. The reporting currency must be separately presented. And the level of rounding off must be separately presented. So which is why they are all.
tell us this. Let's 4.4, right?
Yes, 4.4.
Okay, sir. So for this question, we are
We're
to
already
show
moving to 4.4.
question 4.4, page 69. We are to show the lease liability from January 1st, 2001 to December 31st, 2004 and explain the treatment of the right of use assets.
Okay. I mean, I would advise you to look at the questions.
Okay.
You can snap this, right? Okay, so this question on 4.4 is very specific. This one does not require us to prepare any statements. It does want us to determine the lease liability from January 2001 to December 2004. Let's go. Let's get the question.
A company enters into a 4-year lease commencing on January 1st, 2001 and intends to use the assets for 4 years. The terms are for payment are four payments. The terms are four payments of 50,000 naira commencing on January 1st, 2001 and annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of the lease payments not paid at January 1, 2001, for example, three payments of 50,000 naira, is discounted at that rate. Discounted at that rate is 130,026 naira. Legal costs To set up the lease incurred by the company were 402 naira. Show the lease liability from January 1, 2001 to December 2004.
Okay, this one is almost the same, just a slight difference. So they want us to do the lease liability. Now, what's the PV of the lease rental in 2001? Yeah. What's the PV of the lease rental in 2001? 130. Okay, they gave us. When is the lease rental paid? At the beginning or at the end? At the beginning. So that means we'll deduct the lease rental first. But you'll be very wrong if you deduct the lease rental in year one. You'll be very, very wrong. Because, one, this 130,026, they already told you in the question that is the PV of the remaining 3 years. Is the PV, is in the question, if you look at it. Is the PV of the remaining what? So the 50,000 in year one is not included because it has already been paid. And perhaps since it's paid in the first year, there's no need to do any PV for that. You can't do any present value because it has already been paid. Right? It has already been paid. So we are not owing that. We remove it from it. It will be nil because we are not owing it. It has been paid. So we have a balance of how much? 130,026. Then we'll determine our finance costs at which rate? 7.5%. So what's 7.5% of this? So what's the addition? One three nine. Now in year two, then now you can remove your what? 50,000. Then you will be left with what? 89,778. So what's 7.5% of 89,778? 6,733. So how much is this? So in 2003, we'll remove the 50,000. We'll be left with how much? 46511. So how much will be here? I want to approximate it to 89 so that I can have a rounded figure here of 50,000. So in 2005, I have 50,000. I pay 50,000, nil, 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 nil. So everything nils out here. So it's just the same thing as what I've done here. The difference now is that the lease rental is paid at the beginning of every year, which is why I'm deducting the lease rental first before I'm adding the what? The interest. Because this one is paid at the beginning. So you have to deduct it first. And also, when the lease rental is paid at the beginning, you have to be very careful that whatever PV you have here does not include that of year one because it has been paid. It has been what? Paid. So don't go and remove it. You are not owing that. It has been paid. Don't remove it. This one will be 0. Then the others will just flow naturally. And you need to remember that this one now, this one goes to PRL, the finance cost. This one is a non-current liability and a current. You need to separate it. So out of this amount, this one is the non-current portion. The difference is the current portion. The same thing applies to this. Why for this final year? So the third year, we are paying it everything in the next year. Therefore, it's entirely what? Current. And that's it. So then we need to do the right of use assets. The second leg of this one will come here. Which is 130, 02 what? 026. Is there any amount paid at the commencement date? No. Is there any initial direct cost? No. I just say no, no. How much was paid at the commencement paid? Amount paid at the commencement date? It was 50,000. And there was a legal cost. Initial direct cost. Was there any decommissioning cost? No. Then how much is the cost of the assets? So what's the annual depreciation? $180,428. So we'll depreciate it over the lower between the lease term and the economic life of the asset. What is the lease term of this? 4 years. What's the economic life? They didn't give us, Abi. So we simply use 4 years. So how much is that? 45,107. And that is all that is required of this. That is all that is required of this. Question. No question. Nobody is asking any question. You understand it? Okay. Let's go to Lessor accounting. The first question there is illustration 5 under finances. Illustration 5. Okay. That's page 70.
71.
Page 71. Okay, page 71.
Okay, sir.
Yes, please read.
Okay. We are to show the net investment in the lease from January 1st, 2003 to 31st December 2005.
Okay.
And explain what happened to the residual value guaranteed on 31st December 2005. So the question, a lessor enters into a 3-year leasing arrangement commencing on 1st January 2003. Under the terms of the lease, the lessee commits to pay $80,000 per annum commencing on 31st December 2003. A residual guarantee clause requires the lessee to pay $40,000 or $40,000 less the asset's residual value if lower at the end of the lease term if the lessor is unable to sell the asset for more than $40,000. The lessor expects to sell the asset based on current expectations for $50,000 at the end of the lease. The interest rate implicit in the lease is 9.2%. The present value of the lease payments receivable by the lessor discounted at this rate is $232,502. Show the net investment in the lease from January 1st, 2003 to 31st December 2005.
Thank you very much, Sam. So this one also wants us to know how to calculate net investment in the lease. And that's all just we need. Okay, so how do we do this? Now, this for lessor. Simply want us to determine net investment in the lease. At commencement date, when is the commencement date here? 1st January 2000 and what? 2003. And to determine the net investment in the lease is simply the present value of lease receivable and also the present value of unguaranteed residual value. So in this question, what is the present value of lease rentals receivable? What's the present value of the lease rentals receivable? Again, they can give you annual amount and also discount factor, the annuity factor, you multiply it, or they can give you the figure directly. Which one did they give us? They gave us the figure directly. They called it the present value of lease rental receivable. Okay, so 232,512, abi? 02. Then we had the PV of unguaranteed what? From this question now, what's the unguaranteed residual value? What's the unguaranteed residual value? 10,000. That's correct, Sam. It's 10,000 because the lessor believes he can get 50. The lessee says, I'm guaranteeing you 40. So there's a 10,000 unguaranteed. But we need to discount it to present value. So it will be 1.092, I'll be 9.2%. 1.092 raised to power minus what? Minus 3. The lease term is 3 years, right? So how much will this give us? This is 1 plus r raised to power minus 3. That's this one. So multiply that by 10,000. What are we going to have? Who is giving me figure? 7679. So how much are we looking at? $240,181. But look at this 232,502. Can you calculate it in case they didn't give us? Yeah, please do it. I need everybody to participate. Those of you that don't bring your calculator to class, you are wrong. You are just dubbing. You don't know the value of participating actively in class. You really don't know it. Writing. When we were writing that kind of exam, we don't write. We don't write. I'll go and sit down and develop my own notes. That's why we don't fail any course. That's why we pass. Those they just be writing. What are you writing? What are you writing? Okay, calculate this 232,502. Everybody should participate. And that is they don't even have calculator. Use it. If I catch you there, what are you doing? Odun. Ah, okay. No, now, how did they get? I want to know. In case they don't give you this 232502, Abi, now they gave us. What if they don't give you? They gave us the annual payment. They give us the rate. What if they don't give you? How would you calculate it? Odun, the answer is not on my face now. The annuity factor, 1 plus r raised to power minus n divided by r. Okay, let me give it to you. This is the annuity formula. 1 plus r raised to power minus n divided by r. Those of you that are doing PM, you should have been doing a lot of this. Stephanie, where's your calculator? Is your phone as your calculator? Can I bring it next week? Got you. What did you get? What did you get? I mean, where we should start from is that just get this discount factor. This discount factor shouldn't take you 5 seconds. 1.092 raised to power minus 3, 1 minus answer divided by 0.092. 5 seconds, you're done. What is this annuity factor? What did you get? Ugochi. Timileyin. Sorry? This one? Eh? 2 points. Is that what you all got? You got 2.522. 2.522. I need one more confirmation. 2.522. 2.522. Okay. So we have 2.522. Multiply by 80,000, which is the annual amount. Let's multiply by 80,000. 201 76 what? 60. Right? So, but what they gave you is 232502. It's not jiving. So that means if they hadn't given you in the exam and you seriously know how to do this, you will have used the wrong figure. Why is it different? What's left? Okay, to save our time, because we don't have time. So you see, again, these amounts, this lease rental, it already includes guaranteed residual value. It includes what? Guaranteed residual value. So what you have just done is just the 80,000. You need to also consider the guaranteed residual value too. And in this question, what's the guaranteed residual value? 40,000. 40,000 that will be payable in the next 3 years, right? So we need to discount it to present value. And to do that, you don't use annuity for that. You simply do 1 plus r raised to power minus what? N. So if you do 1 plus r raised to power minus n, what will be the discount factor? That is 1.092 raised to power minus 3. Whatever you get, multiply by 40,000. Sorry? 30,718. Abi? So let's add these two together. 232,478. I mean, you have just given a terrible figures here. Your approximation was too much. That's why we are not getting exactly this. Right? So because I should get what, but even if there will be difference, it should be like 2 naira or 3 naira, not this huge figure. Please start getting used to. I can see you guys are very rusty. You are not by now. You should be used to pressing calculator. Come on to calculate discount factor. It's taking you minutes. If and from next week, if I don't see your calculator on your table, okay, I just have to let you know this. You see, even though I strongly believe that you might not be required to do this, but I think you should know it in case this amount here for lessor, oh, it doesn't apply for lessee. For lessor, okay, this amount includes the guaranteed what residual value. They will have agreed it together. So if the question comes, they separated the annual amount, they now gave you the guaranteed residual value separately. That means they will have considered the two in determining this PV. They will have considered the two in determining this PV, which is what I've explained for you. Even though most of the questions we have seen, they always give you this. But please note this. Okay, we just have to do that diversion. So that settles the net investment in a lease at the commencement date. So at the end of the year, it's just what we have done here. I've cleaned it. It's just similar to what we have done there. So at the end of the year, in 2003, what's the balance brought forward? 240,181. Abi, when is the lease rental received? At the beginning or at the end? At the end. So that means we'll add the finance cost before we deduct the lease rental. So this one is not finance cost now, it's income because it's the lessor. At which rate now? 9.2%. So what is 9.2% of 240,181? Perpetual late comer. What's the lease rental? How much is the lease rental? 80,000. What's the balance carried forward? One eight two 278. So again, this finance income will go to POL as an income, as a finance income after your profit before interest and tax. It comes in there as finance income. While this one will go in as non-current assets. You don't need to separate. We don't separate assets into no. It's just liability that it applies. For assets, you just put everything as non-current assets. You call it either lease receivable or net investment in the lease, as we have called it here. And that's it for year one. That's how it goes into your books. In year two, this is 182,278. What's the finance income at 9.2%? Sorry? 16,770. My lease rental is how much? What's the balance? $119. And in 2005, what's finance income at Deduct what? What do you have as balance? How much? Or DUFA? What does, you don't have to talk to them, you're talking to me. So this 50,000 now, what does it represent? Okay. So you have to remind me your name again. Tell me. That 50,000 left at the end of the lease term, what does it represent?
Represent the final value that you were able to sell the asset.
That's correct. That's correct. Don't talk too much. At least you understand what you're talking about. So Temilolowa said that 50,000 represent the residual value. Yeah. You represent the residual value, which is the amount they can sell the asset at the end of the. But out of this 50,000, how much did the lessee guarantee? 40,000. So at least, yeah, he has investment 50,000 in his books. So at the end of the day, it's either he makes a gain or a loss. So if he's able to sell it for 50,000, it's good. That means no loss. But whatever the case, he knows that he will get how much? 40K. The guy will definitely give him 40,000. He will definitely give him that. Okay? And that is the end of this question for net investment in the lease.
If I'm giving this kind of question in dollars and mistakenly in exams I use naira, what's the implication?
No implication, right? Because they will never, never, never give you a question in dollars.
The reason why I'm asking is I think this question is in dollars.
Because I dubbed it from somewhere.
Exactly.
I didn't remember to change it. I didn't remember to change it to naira. That's why. Never. Never. If they do that, that will be a bonus question because we will tell them that how can you do this? It will be a bonus whether you do the wrong thing or the right thing. They will give everybody free mark because that question itself is wrong. Naira is our currency. They can't use another currency for it. Gloria.
Sir, why is
Oh yeah, Gloria.
so why is Lessor and Lessee arguing about the residual value when the asset will be returned to the owner at the expiration of the
Well, he's just trying to be safe. The guy can misuse it. Though there might be insurance and all of that, but it's just being safe. So just to be on the safe side that whatever happens, ensure that I can get this amount. So usually the lessee will not agree. Like this case now, the guy said he wants to get 50K. The lessee said, I can only give you 40. I can't give you 50. I only give you 40. So that's where we are. Oh, is the PV. Yeah. Yes. Which is why I gave 1 plus R used to pi minus m.
Can we use like we are going to use the two annuity factor,
Yeah.
the two.
Yeah. Yeah. One for the annual payment, the second for the guaranteed residual value. Yes. In fact, that first one is not even going into your books because it's at the beginning. So at the end, what you put in year one is 182,278 as non-current assets. Non-current assets. Why the finance income will go to POL? Assignment. Oh, I've sent you the solution. Oh. Don't Don't look at the solution.
Yes.
Don't look at the solution. So 5.2, there's assignment 5.2. That one is 8 years. So you practice like it's long, right? So please do that. It's the same thing, so I don't have to be doing it again. Assignment 5.2. Now let's go to 5.4, illustration 7. 5.4, illustration 7. Which page is that? Page 72. So let's go to page 72, illustration 7. Page 72, illustration 7. Who is reading? Yeah, I know. I know. Oh yeah, read it.
A lessor leases a property to a lessee under an operating lease for 5 years at an annual rate of 100,000 naira. However, the contract states that the first 6 months are rent free.
Good. So you see this particular question, you see it in your mock exam on the first week of October. I've told you, and I'll watch out for it. If any of you get it wrong, let's wait for that time and see. Now, you see, for operating this is always straightforward. There is no issue there. This is the extent you can actually get to. Because for operating lease, what the lessor should do is just to recognize lease rental on a straight line basis, meaning the same amount of lease rental every year. That is for that's all. So they always twist it. Like what they have here now. They said the annual rental is 100,000 and the contract says that the first 6 months are rent free. In the first year, the first 6 months is rent free. That means that the lessor is supposed to be receiving 100,000 every year. But in the first year, how much will he receive? 50,000. So let's see how that can work. So ordinarily, if not for that 6 months rent free, what we should recognize in our books every year should be 100,000. But now it's not possible again because we need to determine amount receivable over the lease term. And in year one, how much are we receiving? In year 1 to 4, abi, year 2 to 5, that is when we now start receiving 100,000 per annum for the next 4 years. Abi? And that will be how much? So total is how much? So amount recognized to P&L will be 450,000 divided by how many years? And that will be how much? This is the only way we can see. The only reason I'm going through all of this is that the standard said we must recognize equal amount of lease rental every year. Equal amount. Unfortunately, we gave him 6 months rent free. That means in the first year, we are receiving 50,000, right? And in the other years, we are receiving 100. The only way we can recognize equal amount is to know how much are we receiving over the lease term, 450, divide it equally. That is the only way. And that will be the situation in most instances. So the examiner, when they want to ask you questions on operating lease, they will always tell you that, okay, they give him an incentive. They gave him a rent-free period. Don't worry. Just know, okay, how much is the incentive? Remove it from what you're supposed to pay all over. Spread the remaining over the lease term so that you can get equal amount to P&L. But when you do that, there's a fallout somewhere. Yes, there'll be a fallout somewhere. Because if you look at it closely here, if you recognize 90,000 in your books, accounting is double entry, right? You are not receiving 90. You're not receiving 90. So if you debit, if you credit P&L as income, there's a debit somewhere. There will be a receivable of how much? 90,000, because you have not received it. Now, when you now receive, do you know how much you are receiving? 50,000. So that means there will be a balance of how much? 40,000 as receivable. So you must recognize that 40,000 too as receivable, right? And it's still going to be a non-current asset because we are not receiving it immediately. We are receiving it over. So let me demonstrate it to you. So there will be a receivables account or schedule. Let me do more of a schedule for you. I've tried my best as possible to avoid accounts doing T. Like it's intentional because it can make some people fail. And you don't really need any T account to pass this exam. You don't need a single T account, I can tell you. Okay, so receivable schedule. So, of course, this is a receivable. There's always opening balance in an asset account, but here we don't have. Then we recognize our lease rental for the year that we credited to P&L as an income. The other leg, we have not received it. We are expecting it. Let me call it lease rental. How much? 90,000. Remember, this is year one. When we now received, we debited bank, we credited the receivable. Cash received. How much is that? So we received 50,000. Abi? So there will be a balance of how much? That will be balance carried forward of 40,000. So as you are recognizing this to P&L, you must recognize this also as assets. That's the thing with operating lease. This year one, let's see if it's going to even out. In year two, what's the opening balance? How much goes to P&L? How much are we receiving in year two? 100,000. There's a balance of how much? Of 30,000. In year three, how much? How much are we recognizing? How much are we receiving? Remaining how much? In year two, recognizing how much? In year four, recognizing 20,000. P&L, receiving remaining. In year five, bringing forward, recognizing, receiving, balance. At the end of his lease term, then it goes away from our books automatically. This is just technicality around operating lease. If you understand this, that is it. It's not more than that for operating lease. We just need to ensure that we recognize equal amount of lease rental in our books every year. And on this note, I bring the class to a close.